Jamie Dimon, of course, the head of JPMorgan, has been bragging for years on end. I've given you hundreds of his, well, no, let's be fair, dozens of his obnoxious quotes about, oh, you can't paint all the bankers in one broad brush. Us at JPMorgan, we don't have any troubles. We didn't have trouble during the debacle in 2008. Oh, the government made us take that $25 billion in TARP funding. But the government didn't make you take over $40 billion in extra money from the Federal Reserve at almost no interest rate, which you made billions of dollars off of, right? But, oh, what could I do? You know, they made me do it, but we're awesome. We're awesome. We never have any problems at JPMorgan. We got this thing on lockdown. In fact, he said in a health conference in January 11th of 2010, I'm a little tired of the constant vilification of these people, referring to bankers. This is not a casino. No, of course it's not, Jamie. Except we just found out that JPMorgan has lost at least $2 billion. Now Jamie Dimon is saying closer to $3 billion, and some are speculating perhaps $4 billion in credit derivatives losses. Oh, really? Huh. I didn't see that coming, except for the fact that I 100% did. How many times did I tell you about, this risky derivatives trading? You can't keep taking that kind of risk and not lose money. It's a near guarantee. This guy, Jamie Dimon telling me, oh, no, we got this thing figured out. We got complicated risk analysis. No, you don't. It's a casino. You're gambling, and you're incentivized to take more and more risk because in the short term, all your executives will make more and more money. And then in the end, it's going to blow up somehow. If this is only a $3 billion loss, JPMorgan should be ecstatic. Because once these things start to unravel, $3 billion is the tip of the iceberg. In derivatives betting, there's an insane $600 trillion market. Trillion dollars. What is $3 billion? It's nothing. Now that market trades back and forth and it involves the entire market, but it's a comical amount, comically large. So look, now Jamie Dimon before has said, oh, this little problem we're having, it's a tempest in a teapot, really. Now all of a sudden he said, we were wrong, we were terribly wrong, sorry about that. Look, if he's admitting this kind of, we were terribly wrong business at $3 billion, now remember their revenue was $90 billion, so it's not like that should cause a panic, right? I'm wondering if it's larger. And by the way, they won't tell us what positions they had. They're like, well, we don't want more things unraveling. Yeah, I bet you don't. So here's what else is unraveling. Number one, their stock price has dropped by 12%. They've lost $18 billion in value from the company. So their trading loss is at least $3 billion, but now the market is reacting and has shaved $18 billion off of their value. And one of the reasons why is people get it. They go, oh, I got it. They claimed that this was, their trading was to decrease risk. Well, it turns out that was not the case. It turns out Cenk Uygur was right. It doesn't decrease risk, it increases risk. Of course it does. It's a wild casino gambling. It's on positions that they don't even necessarily have. They're betting on X versus Y. It's just open season gambling. It has nothing to do with sophisticated programs and hedging, etc. They said this was hedging to reduce their risk. Now we find out, of course, no, it's not hedging their position at all. They said, oh, we're doing this for the clients. And now we find out, of course, they weren't doing it for the clients. They were doing it for their own betting. Before, the Volcker rule, which said that you can't do your own proprietary trading because it's too risky at these large banks, Jamie Dimon had dismissed it as, quote, infantile. And their arguments made for it non-factual. Now all of a sudden, we were wrong. I'm so sorry. What have I done? Well, here's part of what you've done. Here, Ina Drew, who is the chief investment officer for JPMorgan. Ladies and gentlemen, we got her. Gone. But get a load of this. And this is the perfect example of why they do this kind of risky trading in the first place. Now, she was there for a long time, about 30 years or so, widely respected. In fact, she offered her resignation earlier on in this process, and Jamie Dimon wouldn't accept it. And everybody's like, oh, well, Ina Drew's a legend. Okay, she's so great at this stuff. And then people are like, oh, you're only as good as your last trade. Yeah, if your last trade lost $3 billion, yes, you're only as good as your last trade. Right. Now, why does she authorize it in the first place? Well, it's because, for example, in the last 2 years, she's made over $15 million each year. 1 year it was over $16 million. So let's just say the lowest amount, at least $30 million in just the last 2 years. Now, let me ask you a question. If somebody said to you, hey, listen, if you do risky trading, you're going to get $30 million, okay, in 2 years. But then afterwards, you might have to retire, which is what she's not even resigning, she's retiring. She'll probably get a big fat package out of that too. But your company will lose $3 billion. Who wouldn't take that deal? Who wouldn't take that deal? $30 million. So you think we're going to get that $30 million back because she lost the $3 billion? No, of course, nobody's going to get that back. JPMorgan shareholders aren't going to get it back. Nobody's going to get it back. She's going to get to keep it. If you get to keep that kind of money, and then later it's a problem for your company, who gives a damn? 99% of human beings, given that financial incentive structure, will take the risk and then let it blow up on somebody else after I pocketed my tens of millions of dollars. Now, they're saying other London-based traders might also go down. They haven't yet, but there is reports that Achilles Macris and Javier Martin Artojo might also step down. I love it. One of the guys who made the trades was called Achilles. I mean, it doesn't get better than that. So, and Jamie Dimon was wrong not just about this particular trade, but about everything. They, in fact, do make incredibly risky trades. It is for their own profit, mainly for the executive's profit in the short run. And they do expose not only their own company, but the entire global economic order to great risk and possible chaos, because the next time it might not be a $3 billion trade, it might be a $30 billion trade that goes wrong. In fact, it might be this time. And then if you can't pay it, and then people start raising your interest rates, and then all of a sudden other banks can't get paid from you, well, we have what happened in 2008. And Jamie Dimon, who claimed that he had it all figured out and that was never going to happen at JPMorgan, was 1,000,000% wrong. It's happening at JPMorgan right now.